Still high, but slowing. A better than feared inflation report likely to offer investors a tailwind on another busy day. April's headline figure grew at 4.9% on an annual basis, which is the smallest 12-month rise since April 2021. It's the first reading below 5% in 2 years. The core number, however, still holding tight at 5.5%. That's the key for Fed policy, also rising 0.4% on a month-over-month basis. Joining us now is Matt Miskin, Hancock Investment Management Co-Chief Investment Strategist. Hey, Matt, good to see you. I'm looking at the stock reaction, which is actually pretty positive on this. I mean, I don't even know how to read this number at this point.
Well, it's like you said, it's better than feared.
Right.
If there's a tagline for 2023 so far in terms of markets, it's better than feared. It should be a bumper sticker. And this inflation report, the whisper number on it was more like 0.6. Goldman Sachs thought 0.5. Much of those that were looking at it thought that we're going to have a higher than an estimated inflation number, came right in line. And then there were some positive developments within it. Shelter is the biggest component. That was more like 0.4, down a little bit more relative to last month. But nonetheless, the housing market's going to be that key component. We're seeing some really tricky housing dynamics. The Midwest is doing pretty well. The West Coast isn't doing so well, but overall inflation is starting to subside, and that is good news.
Okay, and so within some of those core areas that you're tracking across this report, you know, as you were, I saw you in the green room, you were taking a bit of a quick but deep dive into some of those figures. You know, what jumps out to you right now as areas where inflation is still sticky, still needs to come down as well?
Yeah, I still think it's rents, housing that are still sticky. You know, you were talking about airlines in particular. That actually started to come down. Yeah. Some of these reopening trends that, you know, really took place relative to last year, that had been really driving some of the inflation. That's starting to come down. So that's been positive. The car market, you know, new cars, I think, was actually down a little bit, used cars up a little bit. But overall, the trends are positive. It's that housing component, though, that has been the toughest one to bring down. Unfortunately, housing prices likely need to come down more to get to that 2% target of the Fed.
But of course, that's going to take time. It always does. Better than feared also feels like the sort of Fed vibe as well, you know, right? That the Fed is not going to have to be more aggressive. Does it also apply to the economy, that we are not going to see a recession?
I don't think so. So that's a great point. So what we're seeing here is all of this has been driven from peak in Fed funds expectations. The 2-year Treasury yield peaked really at the third quarter, fourth quarter of last year, started to come down, risk assets started to run. The dollar also peaked in the third quarter, fourth quarter last year. That started to come down because that's a reaction function of Fed policy. But the thing is, if the Fed really starts to cut, that's when a recession happens. Right now, we're in the pivot, pause, like in the environment type period, but that can't last forever. We think the Fed could be done here, though. If that might have been the last rate hike of the cycle. And if that is the case, I think that is going to be buoying risk assets for the short term. It's just as you go later this year, I think they're going to actually have to cut. And if that's the case, you want bonds over stocks.
If the Fed is done, is that just rally on for the markets?
I think it's choppy. You know, the economic data is going to come in and have to present itself to reaffirm even that pause. You know, the NFIB small business optimism that came in yesterday wasn't that great. In fact, it was pretty bad. So you're still seeing this weakness undertone in the economic data. And if that overwhelms, you know, kind of the Fed pause benefits right now, then that's going to be negative for risk assets.
One of the other risk factors out there that might not turn out better than feared is the debt ceiling. Equity markets don't seem to be too worried about it. Should they be?
Yes. Short answer. Yeah, I don't see it priced in. You know, the VIX where it is, or high yield spreads tight.
But are they really not going to come to a deal when all is said and done?
I think there could be a point where they have to cut spending in the short term. Meaning either furloughs or government spending has to be taken down to some degree.
So in other words, even if they come to an agreement, if that agreement includes spending cuts, that could be bad for markets?
Or if there's an air pocket there where they push this debate on and on and on, and they don't make a short-term resolution to just kick it down, then they're going to have to make some short-term spending cuts. The timing of this could not be worse. The Federal Reserve just went through its biggest tightening period since 1980. The economy is right on the brink, you know, barely holding on here. And now the government is basically pushing this risk on the market. And again, I don't think it's priced in. But if there's any reduction in spending, any reduction in government support and just the economy, that is going to provide an air pocket. We do think it's a pretty big risk.
If there are spending cuts, if there are cuts more broadly that we have to kind of factor into the equation, then what sectors does that have the most risk for in this interim period then?
Yeah, so, government spending in terms of government employees, I think it's just really the jobs report and keeping those people keeping their paychecks, because again, right now, the jobs market has been the most powerful engine of this economy. Government spending, and it was actually a positive to Q1 GDP. If you remove that, Q1 GDP probably wasn't as positive. And again, Q2 GDP might not look as strong. So if you remove government spending and you potentially see people that have lost their paychecks for even a short period of time, again, timing of this could not be worse.
So let me guess, you guys like fixed income as a place to hide for all of this. I mean, this has been a consistent theme for you guys for quite some time, but the environment you're discussing, even though better than fear, like even though the backdrop is good, it does sound like an area where you at least want to have some defensive positioning.
That's exactly right. Yeah, and we've been talking about this for months now. And right now we're in this kind of, everything is just trading in these ranges. And it's the bulls don't win, the bears don't win. But in fixed income, you're getting paid about 5% in high quality investment grade bonds. While you wait, while everybody else fights it out in the markets, you're getting paid to wait. And then you could see, with a duration of 6 years, if the 10-year does come down, the 10-year Treasury yield usually drops 2.5% to 3% in a recession off the peak. That could put a 1 handle on the 10-year Treasury yield by the end of the year. The math on the bond market is that's double-digit return potential, and then you're getting paid 5%. I can't do the math on anything else cross-asset right now to suggest that much return potential. So I get the pops in parts of the market, the equities right now, but we would trim into runs and redeploy into high-quality fixed income.
We had Austin Goolsbee on the program here on Yahoo Finance saying that credit squeeze is beginning here. How does that continue to impact the regional banks that have already been so rattled in the equity markets and for some of them have seen their demise, unfortunately, as a result?
Right. We do see a lot of consolidation in regional banks where there's going to be acquisitions, M&A, to try to basically shore up any positive assets in that and bring it to other places. But at the end of the day, the broader theme is the lending growth is going to plummet. And we got through one report with a Q1 senior loan officer survey where it wasn't that bad, again, better than feared. But again, all these banks are going to be pulling back on loans because they're not going to feel like they have the deposits to be able to make all those loans. And if you pull that back, and mortgage rates are back up, credit card interest rates are high, auto interest rates are high. So the consumer's already getting hit with these high interest rates. But then if the bank's saying, I don't even want to give you the loan, then that pulls back even more economic activity. And that's that multiplier effect, that M2, that multiplier effect. If that comes down, again, it brings you into high quality bonds.
Matt Miskin, John Hancock, yes, right back into the thesis.
Consistency.
Yeah. Matt Miskin, John Hancock, Investment Management Co-Chief Investment Strategist. Matt, great to have you here on set with us. Thanks so much for the time this morning.
Thanks, Brad.
Appreciate
Thanks,
it.
Julie.